Most people think they understand how Social Security and Medicare work, but what many people don't realize is that they can turn on at completely different times. And if you don't understand how they overlap, you can make a decision that looks smart on paper, but quietly works against your retirement. In this video, I'll show you exactly what happens when you delay Social Security, but you need to claim Medicare at 65. Through working with clients who have used this strategy, I've seen how Medicare can dramatically reduce early retirement healthcare risk, while Social Security quietly grows in the background by up to 8% per year until age 70. But delaying Social Security also means that your income has to come from somewhere, right? It's going to come from your portfolio during those gap years. And how you handle that period often determines whether or not the strategy works really well or falls apart. So today we're going to walk through what really happens. If you're new to the channel, I'm your humble host, Benjamin Brandt, and I make these videos to make your retirement even better. So most people assume that your Social Security and your Medicare are inseparably linked, but they're really not. What actually happens is that retirement splits into two separate timelines. Medicare starts and turns on at 65. You may or may not be collecting Social Security at that time. In fact, many of my Super Saver clients wish to defer Social Security beyond age 65. So Medicare starts at 65, and we're starting Social Security at some point in the future. This creates two distinct planning phases, right? We have our healthcare secured phase, that's Medicare. Then that opens up an income gap phase while we're deferring Social Security. Well, why does this split matter? Well, because once Medicare has started, your healthcare risks drop dramatically, which is good, but the income has to come from somewhere. They will be linked at some point in the future, but what about that intermediate time? And for the Super Saver, that means that your portfolio has to become that income bridge. So for most retirees, healthcare is the single biggest expense before they turn age 65. You could also throw taxes in there, but today we're talking about healthcare. That could be private insurance, it could be COBRA, it could be your ACA, that's the Affordable Care Act plan. Those can cost anywhere from $1,200 to $2,500 a month, depending on what access you have to subsidies. And even in rare cases, I've seen monthly premiums exceed $3,000 per month, so it's no small cost. Now, once Medicare begins at 65, that changes really quickly and almost always in a good way. So I wanted to start today's video with a high-level overview about how Medicare works, because it's broken into 4 parts, A, B, C, and D. So let's cover each of these pretty quickly. So Medicare Part A typically has no premium. You pay for Part A during your working years through your payroll taxes, and those costs go away once you turn 65 and enroll in Medicare. Medicare Part B does have a monthly premium. So think about Part B as the other side of the Medicare coin. When you stop paying for Medicare Part A, you start paying for Medicare Part B. Part B premiums are income-based. Now, for most people, the standard Part B premium in 2026 is $202.90 per month. Let's call that $203 between friends. Unless your modified adjusted gross income exceeds $109,000 for single filers or double that, $218,000 for joint filers in 2024. Remember, your Medicare premiums are based on your income from 2 years prior, just because I guess we need to make things as difficult as possible. Now, I'll put up a chart here. You can pause to read the chart, but this is your income at different levels of Part B premiums and then what that might cost in additional Part B premiums. So depending on your 2024 income this year in 2026, you could pay an additional $81 or $487 per person per month in Part B premiums. Medicare Part C, also known as Medicare Advantage, is an all-in-one alternative to original Medicare offered by private insurance companies. Some people choose it, of course, but most of my clients opt to stay on original Medicare paired with a Medicare supplement. Moving on to Medicare Part D. Medicare Part D is prescription drug coverage, also provided by private insurance companies. It is technically optional, but if you don't enroll when you're first eligible and you do need it later, are you going to pay a lifetime penalty? Which in my view makes it optional in the same way that skydiving without a parachute is technically optional, but not recommended. So most of my clients, like I mentioned, are on original Medicare plus a supplement, and that brings their total healthcare costs to about $300 or $400 per month per person before any IRMAA surcharges. So for most people, when they file for Medicare, it's a pretty significant cost savings, depending on their pre-65 health insurance arrangements. I should mention, I see in the comments that people say, you don't say what your acronyms stand for. So IRMAA stands for Income Related Monthly Adjustment Amount. Income Related Monthly Adjustment Amount. Now, I'm probably the only person on the planet that thinks about this sort of stuff, but the M in IRMAA, right in the middle, does not stand for Medicare. You'll never see the term IRMAA mentioned outside of Medicare, but the M stands for monthly and not Medicare. It drives me crazy. I don't know. Now you can share in my pain. But Medicare really isn't just about total monthly savings. Really, it's about risk reduction from two standpoints. Before Medicare, one major health event, or pre-Medicare, just the cost of the plan can derail your early retirement plans. We define early retirement as anything before age 60. After Medicare, we're talking much smoother sailing, right? Costs become predictable, and it's just easier to build Medicare Part B premiums and a supplement into your budget, right? Much more predictable healthcare costs. That's why I call Medicare your health insurance anchor. Now, if you're already collecting Social Security at 65, well, then that's very simple. Enrollment just happens automatically, and your Part B premiums are simply deducted from your Social Security check. But if you're delaying Social Security, that process changes because you're not receiving monthly benefits yet. Really, nothing is deducted automatically. You must manually enroll in Medicare through the Social Security Administration during your initial enrollment period, which starts 3 months before you turn 65, including the month of your birthday, and then 3 months following your birthday. So it's really like a 7-month window. Now, most clients want to be first in line, and they're going to apply roughly 3 months before their birthday. Of course, their benefits are going to start on your birth month, the actual month of your birthday. Once enrolled, Medicare bills you directly. You'll receive a quarterly Medicare premium called CMS 500 covering your Part B premium, plus any IRMA surcharge if that does apply. Remember, we're deferring Social Security in this example, so we've got to pay for our Medicare out of our pocket, right? So we have to go through an extra process to do that. Now, you can pay your bill through your Medicare account. You can pay it by mail, which I would not recommend because checks get lost sometimes, or enrolling by Medicare Easy Pay, which automatically drafts that premium from your bank account each month. Myself, I'm not yet 65, but at some point when I am, that's probably the route I would take, is having it drafted against my bank account. There's one more detail here that I don't want you to miss, especially if you're still working. If you are contributing to a health savings account or an HSA, those contributions must stop once you enroll in Medicare. That means HSA contributions generally want to stop at least 6 months before enrolling, or you're going to risk penalties. If you're already collecting Social Security when you turn 65, the Social Security Administration will automatically enroll you in Medicare Part A. In practice, you really can't receive Social Security retirement benefits at or after age 65 without also having Medicare Part A enrolled as part of that package, right? So they're going to kind of come together. The key point is this: at age 65, healthcare, largely problem solved, less stress, we're doing great, right? Meaning Medicare has more coverage, less stress, less premium. Our overall risk has been reduced, right? That's the easy part. We can kind of set that aside. But here's what happens to your Social Security while you're waiting. Why would I want to defer, right? So for people to understand why they would want to wait, let's learn a little bit more about how those benefits can grow if we do defer. So there's really two very distinct growth phases. From 62 until full retirement age. Now, your full retirement age is probably somewhere between 66 and 67 if you're watching this video. So from 62 to full retirement age, claiming early creates a permanent reduction, right? Benefits are reduced roughly 5 to 6% per year, and claiming at age 62 usually results in either a 25 or 30% lifetime benefit cut. Once you reach full retirement age, the benefits flip. Now, if we wait from 62 until full retirement age, if we defer, we are losing a penalty every year. So that's where we get our growth from in our Social Security benefit from 62 to full retirement age. That flips when we go from full retirement age to 70. So from full retirement age to 70, we get a bonus and Social Security grows by about 8% per year. That growth is guaranteed. It accrues monthly. We're compounding our cost of living adjustments on top of a bigger number. Nothing that's tied to markets, and it's going to stop at age 70. So it's a guaranteed increase. Now, delaying benefits from 65 to 70 increases your benefit by roughly 32%. So a $2,000 monthly benefit becomes $2,640. And if you're the higher earning spouse, well, that larger check becomes your survivor benefit. So if either of you or your spouse might live longer than, your break-even age, this probably makes sense to at least examine, should I defer my benefits? There's going to be a lot of people in the comments that say, I'm not going to defer my benefits no matter what. I guess this video is not for you, but for many people that are open to it, doing something like this, let's say you or your spouse lives 25 or 30 years in retirement, not guaranteed for everyone, but if you do, you could easily add an additional $150,000 to $200,000 in additional lifetime income. So it's not a decision to take lightly. Like anything else in retirement planning, you want to look at all the assets and systems and portfolio decisions, everything together. So, like I mentioned, after that high-level refresher on Social Security and Medicare, if you want help building your own dream retirement plan and looking at all these components together, go ahead and click the link in the description. We can book a call, and we'll talk about how to build a plan together. So here's the trade-off to delaying your benefits. When you delay Social Security, your income from 65 until 70, it's got to come from somewhere, and it's going to come from your portfolio. So that usually means withdrawing anywhere from $40,000 to $60,000 per year for up to 5 years. This is where your strategy either works really well due to pre-planning, or it could potentially fall apart. Because some retirees struggle because they didn't model out this withdrawal period in advance, or they underestimated the market risk, or they pulled from the wrong accounts in the wrong order, and that caused them to give up on their deferral plan and claim benefits early because they're not aware of any other options Or even worse, they underspend the potential of their portfolio for the early part of their retirement, and then they finally get a big raise when they finally collect Social Security at age 70. All of those are less than optimal. That's why delaying only works if your portfolio is built to support it. Personally, I recommend something like retirement income guardrails. You could check out just about any of my other videos to see those guardrails in action. And remind me if I forget, but I will put my free guardrails tool in the description. You can download it for free and model this out for yourself. But here's how to structure your portfolio to cover that income gap between 65 when you claim Medicare and something later, maybe 70 when you claim Social Security. So I use a strategy, what I call retirement runway. Actually, we'll put this as a free download. It's a thinking tool. It's a spreadsheet. You can fill out for yourself. And we'll put that in the video description. But the key to understanding the retirement runway is to understand how to model these cash flows in order to defer your Social Security. So what I would recommend is stop thinking in terms of percentages. An example of that would be a 3% allocation to intermediate bond funds, and change your thinking from percentages to real dollar terms, monthly income in dollar terms. So here's how it works. You take your desired monthly income. Let's just pick, for example, $8,000 a month. Now, we're not accounting for taxes here, so it would be $8,000 gross, something less than that net. And then start counting the number of months between when you retire and when you plan to claim Social Security. So like our example today, let's say you retire at 65 and claim Medicare, but you want to defer your benefits, your Social Security benefits until 70. So 5 years, convert that to months, 60 months. So 60 months times $8,000 a month, $480,000. 6 times 8 is 48. Of course, to support this monthly income, you'd want to model this out as part of a broader retirement income plan. I'm going to assume you're going to have more than $1 million to support having, basically half of your portfolio set aside in bonds and cash. This would be very tricky, and the numbers wouldn't work if you only had $500,000, for example. So we're talking to people that have $1 million or more in this $8,000 per month example. Now you take your $480,000 and you build a runway in order to land your airplane, or if you don't like airplane metaphors, the tracks out in front of you, right? If you like a train metaphor, these tracks or this runway will be your cash flows. So depending on your desired investment mix and depending on your tolerance for risk, you probably want to split your $480,000 across the 7 main types of bonds and cash. So we've got money market, we've got short-term government bond funds and short-term corporate bond funds, intermediate-term government and corporate bonds, and long-term government and corporate bonds, right? So that's the main 7. There's many, many other types of bonds and cash, but those are the main 7 generic asset classes for bonds. Money markets, short-term governments and corporates, intermediate-term governments and corporates, and long-term governments and corporates. So when your runway is set up properly, you're going to be insulated from any short-term stock market turbulence if you want to continue on that airplane metaphor. And you'll find yourself significantly more confident in your Social Security deferral strategy. Because no matter what the stock market does, I know that I've got May and June and March of 2027 and June of 2028. I've got all those modeled outside of the stock market, right? I've got that railroad track set up out in front of me, not because I'm thinking in percentage allocation terms. I've translated that to real monthly dollar terms. So if we've got several years of railroad track out in front of us, it's going to be fantastic for your confidence, and it's going to help you stick to this decision of I'm going to defer my benefits for whatever reason that we talked about earlier. So when the strategy is executed correctly, you enter age 70 with Social Security at 32% higher than your normal benefit, both for you and your surviving spouse. And you've got a smaller tax-efficient IRA, which gives you low RMD pressure. We've got predictable Medicare costs, and we've got more guaranteed income. Remember, our Social Security benefits are 132% of what they would have been. So that's going to do a lot of the heavy lifting risk-free rather than from your portfolio. That's how it's done right. When it's done wrong, well, any number of things could happen, right? We could drain our portfolio too quickly. We could not have our income set up properly, so we're selling stocks at a loss. Valuable early retirement years could go underfunded because we're waiting to take a raise when Social Security starts. A market downturn forces us to take our benefits early, which is less than ideal. We waste some valuable tax planning. We talked about the Roth conversion window, the golden window for Roth conversions in a recent video. And ultimately, total all this up to say retirees are going to end up with lower income, maybe higher taxes, and maybe more volatility. So 2 options laid out in front of you, same rules, very different outcomes. So I really believe that you can't make any of these decisions in retirement planning by themselves, right? Each component of retirement planning, whether that's your portfolio or income taxes, Social Security, Medicare, your survivor planning, your estate planning, your longevity planning, all these decisions overlap, right? We can't look at each of these individually. Everything overlaps together, right? It's like peeling an onion. There's multiple layers. And you've got to account for those in a comprehensive retirement plan. So if you don't have a comprehensive retirement plan and you want one, my team can build one for you. If you want some help doing that, click the link in the description. book a call with me and we'll analyze your situation and we'll make a plan together. So until next time, I'm your humble host, Benjamin Brandt. I hope this video helped to make your retirement even better, and I'll see you in the next one.